Well, welcome everyone to part two of our discussion with Dick Weber on the DOL change in the rules for the financial service professionals when dealing with retirement accounts. In part one, we did an overview and we focused an awful lot on the concept of fiduciary versus suitability standards. In this session, we're going to focus a little more on the servicing and the advising of retirement accounts and a little more on the direct impact on planners, advisors, and agents. So, Dick, specifically, what retirement plans are impacted by the change?
Well, the easiest way to explain it is any plan covered by the Employment Retirement Income Security Act of 1974, affectionately known as ERISA, and those includes profit-sharing plans, defined benefit plans, cash balance, and 401ks, as well as IRAs, Roth IRAs, and IRA rollovers that weren't previously considered part of ERISA's umbrella. All of that is now covered by this new best interest rule. The typical advisor is more likely to interact with clients on the self-directed plans, such as the 401k, the IRA, the Roth IRA, and IRA rollovers, and there may be clients with some 403B plans, such as tax-exempt sponsored plans. Some governmental 403Bs are not covered in ERISA, but generally the not-for-profit employer-sponsored plans are covered by ERISA. So it's a fairly big umbrella.
All right, so what we basically are seeing is that where the ERISA plans, the proverbial pension plans,
right,
usually fell under a fiduciary standard and they were protected, the individual wasn't. And now we're finally bringing in the individual's retirement plans into some of that same protection, right?
Well, let me give you an example. There would be occasions when an advisor working with a client who had her own small business, and she perhaps was the principal and had a few employees, and it would be very desirable for her to set up a retirement plan, and to the greatest degree possible, she was going to get as much as the rules would allow of the lion's share of corporate contributions to a retirement plan. And part of the planning might have suggested that a life insurance policy could be a suitable investment within a defined benefit or profit-sharing plan. Now, under the ERISA's five-part rule, that agent wasn't acting as a fiduciary as other aspects of the original ERISA would have made someone working with a plan a fiduciary. Although even in that fiduciary light environment, the disclosure of compensation was required. So if you have a plan, you're my client, we put some insurance in your plan, I have to disclose to you on an annual basis in the 5500 Schedule A what my compensation was. So that would have been the only intersection that most advisors would have had typically with their clients and their clients' retirement plans. Of course, we're very accustomed to giving advice to people who have IRAs and especially IRA rollovers, and that's where the new rule is specifically bringing those resources under the fiduciary umbrella.
Well, can you provide an example or two of the effect on the IRAs?
Well, the IRA is now going to be treated as under the rule, is one of the types of plans or sources of retirement money that when an advisor gives investment advice for a fee, that's kind of the succinct way of putting it, a type of retirement plan defined under the new rule in which I'm giving advice about moving money into, out of, or around, then that squarely puts the IRA rollover into this new realm of I as an advisor have to put your interests above my own. My compensation must be fee only unless if it's a type of product that comes along with the advice that would typically have commission rather than fee, I may qualify for one of two exemptions, but I can never be exempt from being a fiduciary. The fiduciary duty is forever with respect to that transaction of that client. I may have an exemption for how I get paid.
Okay, well, we'll talk about the exemptions in a few minutes. But first, how specifically were investors being harmed before?
Well, the White House's Council of Economic Advisors has been saying for the last year that they've calculated that commissions, fees, and bad advice cost consumers $17 billion a year. And you know that old phrase, a billion here, a billion there, so soon you have real money. So we're not sure of the source of that data. We don't know how it was calculated. It doesn't seem right. It seems very subjective. But it was the primary PR pitch that was deployed both by the administration and the Department of Labor during the year-long run-up to the final rules that were released 2 weeks ago. So the assumption has been that clients are not as well served in a commission environment and a suitability environment, an environment in which the recommendation only had to be suitable. It didn't have to be in your best interest. That actually is a rather big difference. So let me give you an example of how an investor might have been harmed in the past and how the new rules maybe would prevent that harm. So let's assume that you've got an IRA rollover and it has $250,000 in it, and it's the only resource for income other than your and your spouse's Social Security benefits. I, as an insurance agent, recommend that you take $100,000 of that $250,000 from the IRA and put it into a fixed indexed annuity with a bonus feature that appears to provide additional value. I don't necessarily go into great explanation how that bonus provision also extends the surrender period to 10 years and has a substantial heaped first-year commission, because under the old rules, I wasn't required to. If that kind of an annuity was suitable, that's as far as I had to go. That said, the transaction might still have been suitable. Having roughly 20% of your or 40% of your IRA resources into that kind of investment, that might have been okay because it is a source of providing retirement income, but it might not have passed a best interest or a reasonable compensation requirement that's now imposed that hadn't previously been imposed, because none of that existed under the consideration of suitable. So the focus for disclosure tends to be on advisor or agent compensation, but there are other aspects of the transaction that may have been overlooked in the pre-DOL fiduciary days. From a practical standpoint, the DOL fiduciary advisor, through one of these exemptions we're going to talk about, is going to be vulnerable to lawsuits alleging a breach of fiduciary that, if it's successful, could result in an IRS-imposed fine of up to 100% of the transaction and require full restitution to the client and likely require repayment of the commission to the insurance company. And at least one major law firm in the 2 weeks since the rule has been announced has suggested that conflicts of interest under ERISA standards cannot be cured by disclosure. Now, that had used to be an attribute of fiduciary, was you had to disclose any conflicts of interest or other things that were important for the client to know. And typically disclosure then took away the tension about whatever the topic was. But this firm contends that it can't be cured by disclosure. It can't be waived by the party to whom the fiduciary duties are owed, so that the DOL becomes the arbiter of those conflicts and through its prohibited transaction process. And that's going to be really interesting to see how that plays out over the next however many years.
Well, I think that that's consistent, though, with one of the things that I teach in the behavioral course,
Okay.
in that oftentimes clients or the customer is not fully aware of what products are, even straight out vanilla products.
Absolutely. Absolutely.
So I think that's kind of a necessary step that we've had to go through. So will commissions still be allowed in the sale of any securities for retirement accounts?
They can be. So to receive a commission for a security transaction, you would have to qualify it under the best interest contract exemption. It's called the BIC exemption or the BICE. I've heard it done both ways. I prefer to call it the BIC exemption. And the BIC exemption is yet another rabbit hole. So you've fallen down the hole, you're a fiduciary, now you have to decide how you want to be compensated. If you're going to be compensated by commission, then you have to find the rabbit hole called the BIC. And now there are going to be certain requirements put upon you and especially your broker-dealer, because we're talking investment here, so it would be broker-dealer oriented. And there has to be a contract between the broker-dealer and your client. Interestingly, originally you were going to be the advisor was going to be a party to the BIC under the proposed rules, but that was taken out in the final rules. So there are these very specific requirements in order for me to earn a commission. And those would all be done under the BIC exemption.
So does the fiduciary standard still apply under the BIC?
Absolutely. Nothing waives the fiduciary standard. The only thing that is waivable is the basis on which you can be compensated. In the non-securities arena through the PTE, Prohibited Transaction Exemption 8424, or for securities and indexed annuities through the BIC.
Okay, so again, we have the rabbit hole. Any recommendation that results in a benefit, not even necessarily a commission, but any kind of a benefit to even a planner then would be subject to the new rule, right?
Again, yes, and just to put it in terms to try to be as specific as possible. When there is investment advice for compensation of any kind, when I'm rendering advice to, and it's investment advice to someone who is a participant or a beneficiary of primarily, in most of our practical experience, the self-directed type of retirement plans, especially 401k, IRAs, Roth IRAs, and IRA rollovers. That's what we're talking about.
Okay, so how is this rule change going to impact financial planners of the planning industry?
I think the financial planners who are, let's call them either AUM planners or who are fee-only planners. So there are certainly planners who, from all of their expertise, they've gone through our course at CLU, they've passed the CFP exam the first time, they join a firm, they start a firm that is giving advice for fee, no products. In fact, my financial advisor, it has that kind of model. He will have the smallest impact on him. He will have to change his ADV a little bit. There may be some other contractual or disclosure type documents that will be included in the initial engagement and what is given to me as a client every year. But because his compensation model is exactly what the Department of Labor was looking for, that it was not based on commissions, but was based on something ascertainable, a percentage of something, or simply an hourly fee. Either of those are going to have the least impact on those advisor and advisory firms. The financial planner who at the other extreme is supporting herself mostly by commissions for products that are suitable, that are well considered, that she or he has a written plan, but the implementation is largely through products that pay commissions. She or he is going to have the greater burden, and that they're going to have to figure out with their broker-dealers, and if they're doing any advisory through their registered investment advisor, through their IMO, however they're transacting their business, those entities are going to be quickly formulating how the advisor herself or himself is going to have to interact both with the entity, but especially with the client. How are you going to get compensated? You could move to a fee-based operation. That'll lessen the impact. You could stay with your commission orientation. That's going to have a greater impact, and you're going to have to figure out not only immediately but long term, how is it defensible with the best interest and the reasonable comp issues that are going to play out with what we call the plaintiff's bar as the lawsuits start coming out.
What is the plaintiff's bar?
Plaintiff's bar is a term of art to describe trial attorneys.
All right. So if a planner has a question on the suitability of a product in a client's IRA, or if the client comes to us with a question regarding a proposed product in their IRA, say they're going from a 401k to a rollover, and they've had a recommendation for something, how should we as planners respond?
Well, I think the first question we have to ask is, what role is the client asking us to serve? And so, for example, a client might come to me, or a friend might come to me and say, I'm as you know, I'm in this employment plan, my 401k, and there's been a recommendation that I should move more money out of the money market reserve that I've had in my 401k and put more into some kind of equity mutual fund. What do you think? If I'm responding to that without compensation, if it's a generic response, then our read of the final rules is that does not specifically make me a fiduciary with respect to answering your question. If, however, you're a client and you say, for my self-directed plan, I've been doing a lot of reading and it would seem like I probably should put more of my money in the market. Can you help me do that? Can you make some recommendations about what I should do within my 401k, given what options I have, and I'm going to get paid for that advice for compensation to an intersecting plan qualifying under the rules, then I am a fiduciary with respect to that transaction.
Okay, so it's going to be a function of how it's all framed.
Yes.
Okay. So what are going to be the implications on compliance?
That's a really good question, because I try to think of myself as being head of compliance of a broker-dealer or of a life insurance company, the two entities with which I'm most familiar. I'm a compliance officer of a life insurance company, and I know that we're going to have to start looking at our annuity products and how they're sold and whether or not we're going to attempt to qualify them under the BIC, or whether we're going to it'd still be under the BIC even if I transform the compensation to something like what I was describing earlier, 50 basis points each and every year as opposed to a heaped commission. So I've got to do that with all of the products and that might be sold to those plans, and with all of my agents who might be selling those to those kinds of plans. Then I have to think, well, the good news is that there are still products and there are still customers that aren't triggering this fiduciary event. But do I really want to have compliance processes for two different umbrellas? And I think that insurance companies and broker-dealers are going to ultimately decide that they can only reasonably administer one master compliance process. Because I think if you have two, you're vulnerable to those who fall under the less stringent, that somehow, oh, you're watching out for your agents over here, but you're not watching out for them in this other arena. I think that plaintiff's bar, again, a good juicy case on that going the wrong way for the insurance company, could certainly convince them. And so one possible outcome, I'm not predicting it. I don't know that anyone is actively suggesting it, but one possible outcome is an insurance company or broker-dealer saying everything under the same umbrella. You must act as a fiduciary and all the implications of disclosure and compensation to follow, because we can administer that. We can't reasonably do two different compliance modalities.
So it's going to be the assumption that we're all falling down the rabbit hole.
We may ultimately, of course, we don't yet know what the SEC is going to say. Remember that while we're talking about securities here, we're only talking about securities sold to retirement plans, the traditional plans plus the IRA, Roth IRA, etc. So what if SEC comes out and says, 6 years ago we examined the harmonization of suitability and fiduciary. We got sidetracked, but we've come back to it now. And yes, we believe that there should be a process by which anyone who sells securities has to do it as a fiduciary. Well, that's going to certainly widen the umbrella. And now pretty much everybody's going to be under, who is selling a registered product is going to be under that umbrella. So we have an umbrella that's reasonably wide right now. By the end of the year, the umbrella could be much wider. So it's wait and see. We have to see what else is going to happen.
Is anyone exempt from the new rules?
The general rule is no one is exempt in terms of offering investment advice for a fee to intersecting with retirement money, as I've described it. There are a couple of exceptions. So advice to institutional accounts, meaning plans with more than $50 million, are not subject to the rabbit hole. Those who provide education, and this is a little bit of a slippery slope. When does education become trying to tell you specifically what to do or how to invest your money? But those who provide education and which education does not directly lead to advice to an individual or a plan about specific transactions, then education per se, as long as it stays at a high level, does not push you into the rabbit hole. And a minor issue, trades executed by a broker-dealer does not per se impose a fiduciary duty on the broker-dealer for those transactions.
Although it does fall under the best execution.
Certainly, yes.
Okay. So when do these new rules take effect?
So the rule goes into effect June 7th of this year. There's a 60-day period from the time of the release of the rules and when they are deemed final. 60 days from the date of publication. The first implementation date is April 10th, 2017. So the DOL is giving everybody a full year to get ready. Then there are still there's another delay with respect to aspects of the two exemptions to receive commissions, and those go into full implementation January 2nd, 2018.
Okay. So while this appears to be a step in the right direction, at least from the perspective of the planning community, there seems to be a lot of questions that's only going to be answered over time. It's kind of like the ACA. The devil is going to be hiding in the details.
The devil is going to be in the details, and the other analogy I draw to the ACA is there is a lot of pushback, not necessarily by the pure financial planning community, but those who are dependent mostly on commissions for compensation. There are two pieces of legislation that have already been introduced into Congress. There's a lot of saber rattling about lawsuits and class action lawsuits that may be registered against the DOL, against the government. And the comparison I make is we are now 2 years past full implementation of the Affordable Care Act. The House has passed legislation more than 50 times to rescind ACA. There have been 3 challenges to the Supreme Court, and ACA is still the law of the land. I expect that DOL fiduciary is going to be the law of the land, and we just have to figure it out. And in a lot of ways, whether commission-based or fee-based, I think there's a lot of opportunity here. Again, we just have to figure it out.
Okay. Well, I suspect that we're going to be updating this recording in a year or so.
A year or so, or maybe next week.
Okay. Thank you very much, Dick.
Yeah, it's my pleasure.